Welcome to the Torch Academy. Today, we're going deep on how small businesses are actually priced, the three methods used to value every business. Let me walk you through the big picture. All three valuation methods are trying to answer one fundamental question: what is a reasonable price a buyer would pay? The market approach looks at recent comparable sales. What did similar businesses actually sell for? The income approach capitalizes earnings. If the business makes $100,000 a year, what is that worth? And the asset approach values what is on the balance sheet. You will almost never see all three methods produce identical numbers, but that is okay. Each one is the right tool for different situations, and experienced appraisers use all three and triangulate toward a fair value. The market approach is your first choice when you can find good comparable sales, usually businesses under $1 million. If you are buying a pizza shop and three similar shops sold in your area recently, that data is gold. The income approach scales beautifully. Whether you are looking at a 500,000 or 5 million business, if you know the earnings and you know the multiple, you can value it. And the asset approach? That is your safety net. It is critical for businesses with significant tangible assets, like a dental practice with equipment or a manufacturing company. Smart appraisers do not pick one method. They use all three and weight them based on what matters most for that specific business. It is completely normal for the three approaches to give you different answers, sometimes by 20, 30, even 40%. Why? Because each method is answering a slightly different question. The market approach asks, what did recent buyers pay? The income approach asks, what earning power is worth? And the asset approach asks, what stuff does the business own? A buyer focused on cash flow will weight the income approach heavily. A buyer in real estate sees asset value as critical. A strategic buyer might focus on comparable sales. All three approaches are correct. They are just highlighting different aspects of value. Here is how the market approach works in practice. First, you hunt for comparables. Recent sales of similar businesses. Maybe you are valuing a bookkeeping firm and you find three that sold in the past 2 years. Next, you adjust each comp for differences. One sold to a strategic buyer, so that price might be higher. Another had higher growth. You normalize all of them. Then you extract the multiple. What was the price relative to revenue or earnings? Finally, you apply that adjusted multiple to your own business. If comparable bookkeeping firms sold for 3.5 times revenue and your firm does $400,000 in revenue, your market-based value is roughly $1.4 million. Simple, data-driven, and grounded in reality. Let us work through a real example. You are valuing an HVAC company. You find three comparable businesses that sold recently. Company A did $800,000 in revenue and sold for $1.2 million, so that is a 1.5 times multiple. Company B did $950,000 and sold for $1.5 million. That is 1.6 times. Company C did $700,000 and sold for $900,000. That is 1.3 times. You normalize for differences. Maybe Company B had a long-term service contract that made it worth more. You settle on 1.5 times as your adjusted multiple. Your business does $850,000 in revenue, so your market-based value is 1.5 times $850,000, which is $1,275,000. That is what the market says it is worth. Now let us talk about the income approach. This is the method that asks, what is the business earning power worth? The formula is simple. You take the annual earnings and divide by a capitalization rate. A capitalization rate represents your expected return. If you could buy a business with very low risk and expect 25% annual returns, that is a 0.25 cap rate, which means you would pay 4 times the annual earnings. If risk is higher and you need 33% returns, that is a 0.33 cap rate, meaning you would pay 3 times earnings. The income approach is pure cash flow logic. If the business makes money, that money is valuable to a buyer. How valuable? That depends on the risk and the buyer's return expectations. Here is something that will reshape how you think about your business. Imagine you improve your operations and add 100,000 in annual earnings. How much does that add to your business value? Using a 3x multiple, it adds 300,000. Using a 4x multiple, it adds 400,000. This is why so many successful business owners focus obsessively on profitability before they sell. Every dollar of added recurring profit multiplies into $3 to $5 of business value. It is leverage in its purest form. Let us calculate an income approach value. You have a consulting firm with recasted annual earnings of $250,000. The industry standard cap rate for similar firms is 0.3, which is a 3.3x multiple. So you divide. 250,000 divided by 0.3 equals 833,000. Or you can think of it as 250,000 times 3.3. The income-based value is around 833,000. Now, that is not the final price. Smart buyers adjust that number up or down based on whether the business is growing, how much competition it faces, how dependent it is on the owner, all of that. But 833,000 is what the cash flow says it is worth in a baseline scenario. The asset approach is the simplest, conceptually. You look at the balance sheet, add up what the business owns, subtract what it owes, and that is your value. Equipment, inventory, vehicles, real estate, all of it. This method matters most for asset-heavy businesses. A manufacturing company with $2 million in equipment, a plumbing business with trucks and tools, a landscaping company with machinery. For these businesses, what is on the balance sheet is a big part of value. But for a pure service business or a software company, the asset approach often gives you a floor price that is way below what a buyer would pay. Why? Because it ignores the earning power. A software company might have 50,000 in tangible assets but make 500,000 a year. No buyer is valuing it at 50,000. But the asset approach gives you a reality check. You know the business is worth at least what its liquidation value is. Let me give you a framework for choosing. The market approach dominates when you are looking at smaller businesses where comparable sales actually exist, and you want to ground your value in what the market is literally paying right now. The income approach dominates for larger businesses, or when comparable sales data is thin. It is perfect when a buyer is purely cash flow focused, and when the business is growing or has other unique characteristics. And the asset approach? It is typically a supporting player, but critical for asset-heavy businesses and as a reality check. Most appraisers use all three and weight them by confidence level. Here is the biggest mistake I see business owners make. They pick one valuation method and fall in love with it. Maybe they run the income approach and get $2 million, and they decide that is what their business is worth. But then market comparables suggest $1.4 million. And they just ignore that data. Do not do that. If the three methods give you different answers, that is not wrong. That is information. It is telling you something important about your specific business. Maybe the market is being conservative. Maybe your earnings are inflated. Maybe your assets are undervalued. Dig into the differences. That is how you get a real number. The takeaway, and there's no single formula for pricing a business. Buyers and appraisers use multiple methods, and the results often differ. Understanding all three approaches gives you the knowledge to defend your asking price, evaluate offers intelligently, and spot when someone is using the wrong method to undervalue your business. Thanks for watching. If you found this helpful, head over to torchapp.io/signup to create your free account. Torch uses AI to help you navigate buying or selling a small business, whether you're just exploring or ready to make a move. And don't forget to subscribe for more episodes from the Torch Academy.